So once again, good evening, everyone. So today we are going to be looking at financial modeling. Okay, so we have what we call accounting and we have what we call financials, right? So accounting has to do with the historical data, right? So we are not going to dwell much on that. It's all about you keeping your records. So there are tools that can help you keep your records, all your income, all your expense, and all that, right? So it's about you documenting all that because if you are going to seek for investment, that's part of the document that you need to provide to investors so that they can see the historical data around your income, your expense, and other things that has to do with your accounting. Okay, so but today we are going to look at financial modeling, which has to do with forecasting around your numbers. Okay, so where are you heading to? Where will your business get to by the by 5 years, in 2 years, in 3 years, in so what are you actually, where would you be having more money coming in? Where are you spending much money? So that's what your financial modeling uh, is going to help you provide, right? So before we get into that practically, we just have on the screen some key financial metrics, right? So these financial metrics are important keywords that we need to know. And we're also going to discover them while we start building the financial model, right? Okay, so we have what we call revenue. So revenue is the total income you generate through your sales of your product and services. So the total money you are making, right? So why the gross profit is when you minus the cost of goods sold, right, from your revenue. So you made 100 naira and it costs you 17 naira. So your gross profit, it costs you 17 naira to buy that product. So your gross profit is kind of 30 naira, right? So we have what we call the gross margin. So in most cases, they might ask you what's your gross margin percentage or what's your margin, right? So your gross profit as a percentage of your revenue. So you now need to calculate it based on percentage. So we are going to see all of this, uh, how they come to reality on your financial model. Okay. Then we have what we call OPEX. OPEX means operating expense, operating expenses. So these include your salary, your rent, all the expenses that you make, right? So they are all factored in your operating expense. So in most cases, you can see them as OPEX. So we have what we call the burn rate. So the burn rate, most times you can have them as monthly burn rates. Okay. So you might be asked, what's your monthly burnout or what's your monthly burn rate? So this kind of the rate at which you spend cash, right? So what's your yearly burn rate? So what's your monthly burn rate? What's the rate at which you spend money every month? So if you spend 20,000 every month and you have 100,000, what it means is that you are going to spend that money for how long? 5 months. It's as simple as that. 20 times 500,000, that money will exhaust. So the next thing you have there is a runway. So the runway is the estimated time until you run out of that fund. So that 5 months is your runway, right? So your burn rate is 20,000. Your total available capital is 100,000. Your runway is 20,000. So you are going to, sorry, your burn rate is 20,000. And you are going, if you have 100,000, so you just kind of 100,000 divided by dividing 20,000 by 100,000, right? So your burn rate, dividing it by your total available capital will give you your runway, right? So that means that's 5 months. So after 5 months, you will run out of cash. Okay, so churn rate is kind of the rate at which customers stop using your product, especially for subscription-based businesses, right? So in this case, you might have a product or service that people use monthly, or people come to your shop, or come to access your service, and they come this month, come next month, and they don't love it anymore. They move to another product. So that means you have a churn, right? So you need to make sure that you reduce your churn rate. And there are ways for you to reduce your churn rate. That could be improving your customer service and also improving your products, right? And also innovation, because customers might discover new products and they will abandon your own product because you are not being innovative. So there could be different reasons why customers are churning. Okay, so churn means dropping off, right? So CAC, here does not mean corporate affairs commission. So it simply means customer acquisition costs. So here we are talking about how much or what does it cost you to acquire one customer. You need to know, right? So what does it cost you to acquire one customer? You need to really know, because that will help you in running your business. For example, if it costs you 10 naira to acquire one customer, what it simply means is that for you to acquire 100 customers, it's going to cost you 1,000 naira. So practically, if you don't have 1,000 naira, you can never get that 100 customers. You can never. So all you need to do is to have 1,000 naira that will help you to acquire 100 customers, 10 naira as a customer acquisition cost. Okay. So if you know your customer acquisition cost, that could also help you to know how much you need as capital, right? In terms of investment and all that. Okay. So we have what we call the operating income. So here is your minusing revenue minus your operating expense. So after your revenue, you minus your operating expense, all the salary and all that. So that gives you your operating income. So you can now know what your operating income is. So we have the operating margin. Okay, so the operating margin here is operating income as a percentage of revenue. So here you are not calculating the percentage. Okay, likewise, we have the net income. So net income is now when your total revenue minus it from all expenses, and then you minus tax. So it's kind of removing tax from your operating income, right? So operating income minus your tax. So that will give you your net income. So the net income percentage is kind of the percentage around that. So let's dive into the financial model proper, right? And we are going to see how most of these things are applied on the financial model. Okay, there are other important, like call them financial metrics, that might be useful. So you might have your ARR, MRR, and all that. But this happens to be the basic that we need. Okay, so let's not dive into that. So one thing I also want to emphasize on is that you practically don't need to have kind of degree in finance, in mathematics for you to dive into this. All you need to do is to understand your numbers. And business is about numbers. Business is all about numbers. If you don't understand your numbers, you don't have any business. From the number of customers you have, that's number. Number of employees you have, that's number. Amount you pay your customers, that's number. You pay your employees, that's number. Your revenue, that's number. Everything you have to do about business is all about number. So that's why we say business is all about numbers. If you don't understand your numbers, you don't understand your business. Also, one thing I've also understood or come to understand about financial model is that if you have a proper and a good financial model, it helps you to understand the business you are running. It's kind of business model, right? But in this case, you are using numbers to explain your model, right? So there are a lot of reasons why you need a financial model. I didn't remember to get that across to us. So there are a lot of them. I won't dive deep into that. So it helps you to understand your business, like I earlier mentioned. It helps you to know where you are where money is coming in more, what is giving you more money, where you are spending more money, and a whole lot of other things. It helps you to make good business decisions and all that. Okay, so I want us to just go into the practical section proper, and maybe after the call, we can just share the importance of having your financial model. All right, so this kind of a template, you don't need to be scared about this template. There are different types of templates, especially for different industries and all that. But at the end, all you need is to have a clear and overview of what your revenue is, what your margin is, what your operating expense is, what's your operating income was. So having all those things clearly itemized, that will help someone to that can give insight to anyone to understand how this business is going to go over a period of time. So that's all, right? So you can have simpler templates, you can have different kind of templates and all that, but for the purpose of this section, we are going to be using this template, okay? And you are free to check out other templates as the case may be. All you need is the knowledge for you to understand how you can even design your own financial modeling templates and use that basically for your business. Okay, so let's dive in. So rules, few things you need to know about this template and probably other templates. One is every place you have the blue kind of figures, any place you have blue, that's assumption. So it's an assumption and you can change it. Okay, so you can change all those assumptions based on your own business, right? But the black aspect, the black numbers, you are not meant to change them. They are going to be calculated or generated based on the assumptions that you have passed. Okay, so we have, if you check here, we have three tabs. If you can see my mouse move. So we have three tabs. We have the customer acquisition model tab, we have the monthly model tab, and we have the income quarterly run-up tab. Okay, so we are going to clearly explain each one of them, starting from the customer acquisition model. Okay, here, the first tab, which is here, is just kind of a sheet where we are going to put our assumptions based on our marketing spending, our marketing budget. How much do you want to spend monthly, over time, and all that? So this template is structured for 4 years, right? So where you have M1, M2, that means month 1, month 2, month 3, month 4. So if you keep moving, the end will give you month 48, right? As you can see my screen. So that's month 48. So that month 48 means if you calculate month 48, that will give you a total of 4 years, right? So, but you can do 3 years. COVID came and it's recommended that you can do something like 3 years, right? Not really doing 4 years. So you can do 3 years, depending, you can do 2 years, but in most cases, recommended that you do 3 years. Okay, so if you want to do 4 years, that's fine, depending on what you're using it for. Most importantly, understand, have the knowledge on how to build your financial model. All right, so like I said, this is where we are going to put the assumptions for our marketing, our marketing spending, our advertising spending. So what we are going to do for the benefit and clarity of this section is that we are going to pick a kind of an assumed business, and then we create a model for it. Okay, so let's assume we want to create a model for I think, okay, let's just use Ikechukwu's business, I think, if I'm not mistaken. So let's assume we want to create a financial model for Okay, let's just use something that would be kind of easy. Okay, so let's say we are creating for Igwe Praise business. Okay, let's assume that that's what we are doing. So they are they are building a business, they are building a startup which is on-demand movie streaming platform. So people have to subscribe and all that. Okay, so some of the things I'm going to explain might not be applicable for your business. So I will also give emphasis to that. So please pay attention. You don't need to worry about most things. All you need to do is understand one column. One column is similar to all of the columns, right? All right, so let's get started. Now, this is advertising spending. So someone can call it marketing spending. So here it just write-ups. So I can call it marketing spending as the case may be. Okay, so as you can see, I can change this. So we are going to send this template for you and you can probably change, but be careful, like we said, be careful, change it based on understanding of how this works. So this is marketing spending and or you can call it advertising spending. So what this simply means is that we are saying, hey, we want to spend uh, kind of every month we want to spend 40,000 or 50,000 naira every month on marketing or advertising, right? So we can call it advertising. So let's say our channel is advertising. So you understand why I say advertising. So your own could be marketing. Maybe you don't run adverts. All you do is kind of uh, marketing, right? So advertising, spending, as the case may be. So let's say we are going to be spending 50,000 monthly. Now here I can drag this. As you can see, I can drag this. If I drag it and stop at 6, as you can see, all of them will become 50,000. So this is just Excel kind of skills. You might just need to understand how to use Excel, basic Excel usage. I'm not an expert, please. I'm not a financial person. I am an entrepreneur who understands that numbers are important and I need to understand my numbers. And I understand I'm a tech person, I'm an IT person, so I have basic Excel skills. Okay, so I'm not a financial expert. All right, so as an entrepreneur, you need to understand your numbers. I'm encouraging you so that you don't think, oh, I'm an expert and that is why I'm doing what I'm doing. No, I'm not an expert. I've done this over years. I've trained people building their financial model, but I always say I'm not an expert. Anyone can still do what I'm doing. Okay, so what I just did here is to say we are going to be spending 50,000 for the next 6 months. So as you can see, we have 50,000 to here. So if, for example, on our 7th month, we want to increase our marketing spending to probably, let's say 80,000, I can increase this to 80,000, right? So once I increase it to 80,000, I can move this and maybe we want to stop at month 12. So here we see we have stopped at month 12. So month 13 happens to be the second year. So from month 13, we can say, okay, we want to increase our marketing spending to 100,000. So we are going to be spending 100,000 all through till month 24. So in this case, we have month 24 as the case may be. Maybe month 24 is the 2 years. So from here, I can say, okay, we want to now spend 150,000 every month. So I can drag this till maybe want to spend it for the next 1 year. I think that should be till 36. Okay, so here we want to spend 200,000 and for the last year. So remember, this is structured for 4 years. So if you are doing 3 years, it should stop around 36 if I'm not mistaken. So, but I'm going to calculate quickly to be sure that I'm right. Okay, so that's that. So 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12. So I'm correct. So from 37 is year 4. Okay, so we are right. Now, so you saw what I did from the advertising spending. So it's like we said, it's an assumption. You need to make an assumption based on what you think you are going to be spending. Any figure you put, that's what it's going to give back to you, right? So someone could be spending 1 million naira every month, right? Most startup companies you see spend maybe in a month $50,000. Some people spend 20 million naira running ads, right? So they might have raised $1 million, they might have raised, so they can spend that money to acquire more people. So you also understand that the more money you spend, which is invest, you are likely to get more customers, right? So, and also the strategy and all that. Okay, but let's continue. So the next. Okay, so just in case my network keep misbehaving, please just pardon me. I would I would try to come back and then continue where I stopped. Okay, so sorry about that. Now, paid CAC here simply means customer acquisition cost, like we earlier explained, right? So we explained what customer acquisition cost means from here. Okay, so CAC, customer acquisition cost, the cost of acquiring a customer. So when we spend 50,000 naira, what does it cost us to acquire one customer? It is very important for us to know what it costs us to get one customer. So in this case, we might be spending 50,000, but for us to get one customer, depending on the nature of your product, it might be costing us 1,000 naira, right? So what does this mean? This means, if you run an ad, let's say billboard, radio ad, and all that, you might have millions of people listening to it, but not everybody will pay or end up buying your product. So we have what we call acquisition, we have what we call activation. So you might acquire people, what we call lead generation, but you need to convert those leads into sales, right? Into customers. That is now when you can say those people are real customers, they have been activated. So in this context, what it means will be, how much does it cost you, right? So you spend 50,000 naira, okay, to run an ad, and at the end of the day, you get 50 people from that ad. What does it mean? It means it costs you 1,000 naira to get. It costs you 1,000 naira to get one customer. So you can see the formula. The formula is very simple. The total amount spent on marketing divided by the total number of people gotten from that campaign. That gives you the cost of acquiring one customer, right? So you spend 50,000 and you got 50 people. What it means is that you are doing what? You are spending 1,000 naira per person. Now, if you spend 50,000 and you get 100 people, what it means is that you are spending 500 naira per person. So what you can see here, okay, so I'm going to change this, okay? So remember, we are using new subscriber, okay? So we are using new subscriber. The template was for a car kind of business. So what we need here is a new subscriber that is going to be using the platform. So here, we spend 500 naira to get one person. So we spend 50,000 and then we have to get 100 persons once we spend 50,000. What it means, our CAC is 500, right? Okay, so beautiful. So what we now need to look at here would be, in this case, remember we spent 500 here. So I can drag this and I can drag it to the end as the case may be. Maybe let's say our CAC remains the same to the end, right? Till 4 years. So it costs us 500 to acquire customer all through. But remember, this is an assumption. It might not cost you 500 to acquire one customer. in month 7. Maybe you have discovered strategy, or you now have more people that are marketing for you. It has increased. So you now need to design a model that is real to your business. Okay. So I only assume that we are going to continue to spend 500, which is not really realistic. You should be innovative enough to find a way to reduce the cost of your CAC. Because if you reduce the cost of your CAC, you are going to get more customers, right? So if we reduce the cost of this CAC to 100, what it means is that our customers are going to increase to 500. So you need to know, what are the numbers we need to increase? What are the numbers we need to reduce? So you need to continue to reduce your CAC, which is your cost of acquiring a customer, so that you can have more people. You can reduce that based on innovation, creativity. Maybe your content can help you get more people. You can spend 50,000, but at the end of the day, you get 50 people. Another person spend the same 50,000, but get 200 persons. So it could be through creativity and all that, but I don't want to dive into that. Your model should clearly explain that. So when you are speaking to an investor to say, okay, at this point, this changed, and this is the reason. Because we extended our shop, we are opening a new shop, we are going to have more people. Because we are doing this, so your financial model is kind of using numbers to explain your business model, right? So for everything, you need to explain it, okay? So someone else can come here and say, in month 12, we are going to spend more money. From here, okay, from month this, we are going to spend more money. January, we reduce based on the nature of your business. Maybe your business is a seasonal business that October, November, December, you need to spend more money on advertisement. So you need to factor it in here, right? I am building on this so that we can understand clearly how to work with the financial model. Okay, so all right, so let's go on. I'm just using basic numbers so that we just have insight, but you have to be creative. So let's look at this. So new subscribers, here we have 100. So you know why we have 100 here. You know why we have 100 here, because of this. So if you watch on month 7, you see we have 160 people. Why? Because our spending, our marketing spending, our advertising spending increased. We invested more money, and we have this. At the end of the day, we are going to have 160 customers at the end of the day. Okay, so I believe this part is clear. So if you also move on maybe to the last month where we spend 200,000, so you can see that we are going to get 400 customers. So like we said, this is practically how much did you spend? You spent 200,000. How many customers did you get at the end of the day? You got 400. Okay, so your cost of acquiring one customer is 500. I believe that's clear. Now, the next thing we have here, where we have the M1 plus recurring. So at this point, what it simply means here is it's a reflection of your churn rates. So here is a reflection of your churn rates. At this point, your churn rate, as we mentioned here, happens to be the rate at which customers stop using your products or service. So you need to factor in that assumption that a customer might not end up using your product like for 100 years. They might use it for 1 year and they are no longer going to use it. Remember, there was a time during one of these sections when we talked about the customer lifetime, and we also talked about the customer lifetime value, right? So your model can also explain the lifetime value and the lifetime of a customer. So here we can say if someone subscribed to, let's say assume that we have 30%. Let's assume we have 30%. This is in percentage. So let's assume we have 30% here. Okay. So what it simply means, I hope I'm using the right template. I just hope, I just wish. Okay, so let me confirm something. Okay, sorry. I think it's from my end. I need to put percentage here. All right. Okay. So this should be in percentage, as you can see that arrow. So if we have a churn of 30%. Remember, 30% means 30% customers stop using our products. 30% of the customers stop using our products. So how many customers do we have here? We have 100 customers. If 30% stop using our products, how many will remain? It will remain 70. Can you see it here? So it will remain 70. So if 50% of customers stop using our product, it will remain what? 50, right? If 90% of customers stop using our product, it will remain what? 10%. So what we are saying is that 10%, 90% of customers stop using our products, which this means that this is not a good product. But you have to be realistic. At the early stage, they might be churning off. You can now also explain why your churn rate will reduce in second year or in third year. Okay, so but let's assume that we have an average 30% churn rate. Okay, so if you watch here, this is if we say 0% means nobody went out. So look at the total here. If you can see my mouse, look at the total here, meaning that this total number of people here are also coming back here. None of them went out. So because you have a 0% churn rate, nobody left. Have you seen it here? So that means the new people you got is 100, the existing people 170, a total of 270, giving you the total number of customers for this month. But let's assume that we have a 30% churn rate. So you see, this is going to reduce. So I'm making an assumption to say we have 30% all through churn rates till, you can say 30% for the first year, then you reduce it to 20%, reduce it to 5%. You can do 40%. All of these are based on assumptions and they must be realistic. Okay, they must be realistic. Let me tell you one important thing you need to do while building your financial model. You need to have an open mind, right? You need to have an open mind. Reason being that your financial model tells you the health of the business you are building over time. So that if you know that this business is not viable, it helps you to know if this business is viable. This business is not viable, it's not profitable. It's okay, you might not make profit in the first, second year, but you cannot begin to see profit in the third, fourth, fifth year, growing and all that. But by the time you're designing your model, you see that this is not really profitable. You can know that the model you are working on does not really make sense, or this business is not something you need to venture into, and you must be honest with yourself and move on and start a new business. Why? Because you are seeing the numbers real with your eyes. That's why you need to tell yourself the truth. You can't be deceiving yourself trying to put big numbers that you know that are not real. At the end of the day, you'll crash. So that's by the way. Now, as you can see, we are done with the first tab, which is the customer acquisition model. So here this can easily tell us how many customers we are getting in month one, right? If I sum this, although there is a place we'll not get to see the total number of customers we are getting, okay? So which is where we have the income quarterly roll-up. So here we are going to see the total number of customers. We don't worry about the down one. So we are going to change this. This is not total car wash. So we are not going to turn it to total subscribers.
Hello, sir.
So this happens to be the total subscribers. I think my network is still trying to do kind of unstable, but let's still move on. All right, so at this point, quarter one, you already know what quarter one means. Quarter one means 3 months, right? Quarter two means 3 months, 3 months, 3 months, making it 1 year. So the first 3 months you are going to get this. The next 3 months you have this. The next 3 months you have this. The next 3 months you have this. Meaning you are going to have a total of 2,706 subscribers at the end of one business year, which is 12 months, right? So look at how it works. So it calculates the total from here, 1, 2, 3. So as you can see the summation of this, if you can see here, if you can see this place, it shows you the sum, which is 489, which is the first 3 months. That's the summation of them. So if you check here, that's why we have 489 for the first 3 months. So this is kind of breaking down your numbers in a quarterly so that you can see how many customers you expected to get at the end of the quarter. Okay. Now, if you check the next guy, which is 1, 2, 3, which is the next 3 months, we have 852. 852. So we need to check here whether it's correct. So as you can see, this is not really correct. 852. But see what is showing us here, right? So meaning that the formula here is probably not correct. Okay, probably not correct. So let me confirm again. 1, 2, 3. So probably not correct. Okay, so we'll check the right template that is correct and then send it across to us. So all I need you to do is to have the knowledge. Okay, for example, if I want to fix this guy, let's be sure that we are wrong. If I want to fix this guy, I can still go ahead and do the summation to confirm. Remember, we are targeting the first, second one, which is 1, 2, 2, and 3. So we hit this. So have you seen it now? It's correct now. 8, 2, 5. So as you can see, probably I'm using the wrong template that the formulas were not, maybe I did not check the formula, but I just want you to understand, get the concept. Okay. So as you can see, I fixed this guy. So if you check here might also not be correct. So because you have the knowledge, you know how it works. But if we fix the template, you don't need to do all this. Okay. I usually miss the updated one with the one that is not updated. So if I want to do this, so this will now be month 7, month 8, and month 9. So this will give me the expected number of customers for this. So like I said, just pay attention to what we are doing. My network might just drop and I'll come back quickly. Okay, so I'm sharing back my screen and we'll get back to where we are, where we stopped. Okay, I just believe that you can hear me. I know I get to know the point where my internet will just interrupt, then I'll go back to it. All right, so I wanted to fix the last guy, which is this. As you can see, it might not be correct. So all I need to do is to, you are not going to be doing this, please. I just want to fix those ones. So I'm going to do 10, 11, 12. So that will be for the last guy. So that will give me this. So we are going to have a total of 4,021 subscribers for the first year. So if we look at that, let me just do the summation from here. I can just sum these guys here. So for the first month, which is the 12th, so this is 4,021 customers. So let me confirm it from here. 4,021 customers. So you see, I've been able to figure it out. So that makes it correct. So we are done with this part, which is the customer acquisition. So this tells me, oh, we are going to acquire, we are predicting. So that's when if an investor asks you, give me your projection for next year, you know your projections, right? So you can, and you need to know your numbers. You don't need to carry this thing and go anywhere. You need to know your numbers because you need to be the one to design your financial model. So you can easily say, by 2023, by the end of 2023, we are projecting a total of over 4,000 subscribers, right? So that is 4,021 subscribers. So you can be specific to say you are looking at about 4,021 subscribers. So why are you saying this? Because you have a clear projection. How much are you spending to get those people, right? How much are you spending on advertisement? So if you check the summation till till 12 months, you're spending how much? You're spending 780,000 naira, right? Based on the assumption you have given. All right, so let's jump into the next tab, which is the monthly model. Remember, the black parts are not to be changed. All you need to change happens to be the blue part, which are assumptions. So these are black, so you need to go down. So below here, you're going to see the assumptions. So this way, you are going to start changing, right? So I'm going to explain all this. So as you can see, assumptions. So you're going to start changing the assumptions. So we have different sections under the assumptions. We have the revenue assumption. We have the COGS. COGS means cost of goods sold. This means what does it cost you to produce one of that product, or what does it cost you to deliver one service? That one service, what does it cost you? So let's use shoe, for example. If you kind of produce shoe, and for you to buy the gum, all those things, buy the leather, to produce one shoe, one pair of shoe, it costs you 1,000 naira. That is your COG, right? Now you sell it 1,500, right? That happens to be the revenue. So if you minus your revenue from your COG, right? So that will not give you the what? Your gross profit. That's why we have to do a little bit of this. That will not give you your gross profit. So in this case, your gross profit, you have not included the amount, the expenses are around your rent, your NEPA bill, your salary, and all that. Okay, so it does not include that. All right. So as you can see, we have the operating expenses assumption. So this is also an assumption, operating expense assumption. So we also have the other operating expense assumption, right? So, and all that. So this is just all we have here. So let's now begin to break it a little bit down. Now, remember, we are trying to create a financial model for a movie streaming platform. So the revenue assumption here is going to change. So revenue assumption means, how do you make money, right? So we make money through subscription. So we are going to change this and call it customer subscription fee, or we call it subscription fee. So we make money through subscription fees. Okay, so what do we charge every month per subscription? GoTV has what they charge, MTN has what they charge, XYZ have what they charge. Now, what makes it a little bit complex might be that you have different plans. You can charge 10,000, you can charge 15,000, you can. So what you can do here is to use your average pricing. So this model does not allow you to come and start creating multiple of them. So you can use an average pricing to know an average customer pays this in a month. For example, if you have two plans, you have the one for 3,000, and you have the one for 5,000. So let's say 15 people, 10 people pay for 3,000, 20 people pay for 5,000. You know how to do the average, right? You sum and divide, and you know what the average. So the average could be 3,750 naira. That becomes your average. So you use it to draw your assumption. Okay. So here we are assuming that, excuse me, we are assuming that, sorry, let me just take a bit water. All right, thank you. So we are assuming that the subscription fee happens to be Netflix.
Abby.
So Netflix charges, I think is it 1,000 or 1,500? So let's assume they charge 1,500. So for us, we want to charge 1,000 per subscription fee. So I'm going to drag this. As you can see, I've dragged it to 3 months. So I can drag it to the end. Okay, so this will also help you. Your financial model will help you to know what pricing you will set. So by the time you do 1,000 naira, you see that you're not making enough money. You are spending a whole lot. You cannot say, no, let's charge 1,500. If we charge 1,500, that's when we can become profitable. So it helps you to also know what pricing will be right for you based on the expenses, all that, your profitability. You cannot say, no, we can't charge 1,000. If we charge 1,000, we cannot be profitable, right? All right. So another thing could be, is there another way we make money from one customer? So we can add it here. Okay. So let's say we have a business model where somebody needs to pay 1,000 naira subscription fee, and they also need to pay maybe 100 naira for so we can factor that name here. But for here, we don't have any other thing, so we can just leave it vacant. Okay, so if you have, you can put it here. So I'm going to just put 0 here. Okay, so we don't have any other fee here, so I'm going to drag it to the end. So we don't have another revenue more assumption. Okay, so you can keep leaving your questions on the chat and I will respond to it hopefully later on. All right, so here means refund. Okay, refund of new refund. So how many percent of people are you refunding? Okay, so you can have a business where usually each time you sell to 100 people, about 2 people say, I beg, give me back my money, right? So you can factor it in here if there is case of that. Also, your model could be that you provide a customer can like all your promise to customers happens to be, okay, sign up, we charge you, but if you're not okay, we'll refund you back your money. So you can factor in here to say 5% of the customers always take back their money. Okay, so this will factor it in. So that's the essence of this. So if you don't need it, you just leave it at 0. Okay, you just leave it at 0. Okay, so we can say 5% of people always ask for a refund based on the model you are designing. Okay, you can leave it at 0 as the case may be. All right, so I just drag it to the end so that all of them will be 5%. Remember, all of them must not be 5%. At some point, it might reduce because you are creating more, your value is now becoming more clearer. You are building a better brand. So the percentage of refund will not be dropping, right? So the next guy here happens to be discounts. Okay, so maybe usually December period, which is months 10, month 11, 12, used to give discount. So you usually give 10% discount. So you can factor it in here and say we give 10% discount here. We also give 10% discount here. Okay, so you need to also understand when again will be December, right? So December again, it should be 24. So you need to give 10% discount here. So you also need to give 10% discount here. Remember, you give it October, November, December. Okay, so based on the model you are designing. So another time will be around 36, right? So around 36, you give another 10% discount. So you see how I'm designing this model rather. I'm designing it because I understand my business. If you don't understand your business, you can't create a model around it. And your model helps you to understand your business better, right? So This is 10%, 10%. So if you watch what I did here, I'm making an assumption to say 5% of people always ask back for their money. I'm also making an assumption to say every October, November, December, we give 10% what? Discount, right? So yeah. Okay, so I'm done with my revenue. Now, since I'm done with my revenue, let me go up and see what I have. Remember, once you have your assumption, it will generate for you. Now, let's look at this. So all I need to do here will also be to change this guy, to carry this guy. Remember, I'm changing this template to a movie streaming platform. So I can change this guy. That's why I have this. So I can change it back to this. So now look at this. Month one, our revenue for subscription fees is 100,000. So how is it 100,000? So why is 100,000 is that we said that our subscription fee from our assumption is how much? Is 1,000 naira. Now, if our subscription fee is 1,000 naira, how do we now have 100,000? We have 100,000 because in our month one, we have how many customers? We have 100 customers. So 100 times 1,000 will give us 100,000 naira. So have you seen how we got 100,000 naira for month one? That is also how we got this. So if you look at this, what it means here is that we have how many here? We have 170 customers in month two. As you can see it here, 120,000. So look at this. This is 219. 219. So that is why we are going to likely have 219,000 naira here. 219,000 naira. Remember, the subscription fee is how much? 1,000 naira. So everybody will have to pay 1,000 naira. Now let's now look at this. Okay, so see here, we don't have another revenue here, so that's why we have this. So look at this. The refund here, what do we have here? We have 5,000 naira. So we said 5%. Always say, give me back my money. What is 5% of 100,000? That is 5,000 naira. That is why we have this. Remember, in our assumption, we made an assumption to say 5% will always say, give me back my money. So when 5% say, give me back my money, 5,000 naira will be deducted here. So the total net revenue here is giving us how much here? 95,000, because you made 5,000 and 5% are saying, I need my refund. So the total money you are going to have here becomes 95,000 naira. All right, so the same thing here. I don't need to explain this one. So what is applicable here? Month one is the same month two. Like I just explained, the fact that what happened here is based on the total number of customers for that month. The same here, the same here. So that's why you see the revenue is increasing. So if you acquire more customers, you are likely going to do what? Have more revenue. But you have to be realistic, okay? So let's move on. So let's go back to the assumption and then move on. Now we are done with the revenue assumption. Let's look at the COGX assumption. So here we are now going to look at what are the expenses, what are we going to do to service one customer? What does it cost us to service one customer? Okay, so here, now we are not going to remove this. Remember, we are not doing a car here. So for example, we are going to be, what are we going to be spending here? For example, we are going to be having kind of after sales. So we can have customer support here. Okay. So we can have customer support. So let's say someone subscribes, we can call the person and say, thank you for subscribing to service this month, or we send you an SMS. So that SMS we are sending is 4 naira. So we need to capture it, right? It's part of the money we use to service one customer, right? So if a customer pays 100 naira, we send them a gift of 4 naira. That means that we need to factor that 4 naira. Okay, so that's by the way. Now, another thing here would be, remember that people will pay, customers will pay using payment processing platforms. So you might have integrated PayPal, Stripe, Flutterwave, Paystack, and other payment processing platforms. So we can factor them in here. So we can say payment processors. Say payment processors, okay, or payment charges or what have you. So usually like they charge an average of 1.5%. So they charge an average of 1.5%. So this is turning to 2% because I need to convert this to 2 decimals. Okay, so I just converted it to 2 decimals. So it will remain 1.5. So the payment process. So let's say you are building a model where there are agents, right, that takes 25% of every money you generate. So this is where you can factor it in. So in that case, you need to factor in that agents, right, will take just some amount of money from every money you realize. So from every 1,000 naira a customer pays, there is 1.5% that goes to the payment processor. There is 4 naira we used to spend for what? For customer support, or 5 naira. Okay, so we send you an SMS and order. Maybe we send you 2 SMS within that month, right? So we send you, let's say we are using bulk SMS 2.5, 2.5. So we send you kind of thank you for your subscription this month. Then by the time your subscription is about to expire, we tell you, oh, your subscription is about to expire. So that could be SMS. We are factoring it here as customer support. Okay. So you see, you are building a realistic model. And all of these things, 5 naira, it will surprise you that 5 naira is a whole lot of money by the time you have 10,000, 1 million customers streaming your platform. Okay, so I'm dragging this to the end so that all of them will be 1.5%. All right, so customer support. So I'm now thinking, is there any other thing that we have to incur while servicing one customer? That's what I'm just thinking. Is there any other thing we might need to? Oh, my network is a little bit unstable. Okay, so movie license. Okay, yeah, interesting. Movie license. Okay. Yeah, sorry, I wasn't looking at the comment section. I just wanted to concentrate. I don't want to lose focus. Okay. We are talking about numbers. So all right, so let's call it movie license. So for every movie that each person watch, right? But you need to also consider whether it is a cost of servicing this customer. The reason being that, let me give you an example. Let me give you an example. The example here is, what is the model? Because the model here could be that it is not dependent on the customer. So imagine you have only 2 customers streaming a movie. Does that determine how much you are going to spend on licensing? No. So it will be wrong for you to capture it here. So what it's going to be an expense that you have, not based on customer. Remember, COG happens to be the costs associated in delivering that service or product, not the entire product or the entire service. So if you look at movie license, you might have a movie that you have spent 1 million as license and only 2 people watch that movie. So you can't come here and say movie license. So you can't come here and say movie license and kind of say, let's say the license here is 200 naira, for example. If you do this, means that imagine you have two customers. That means what you paid for that license is how much? 400, which becomes wrong. Have you seen why you need to really understand? So don't mind me. I I'm saying this because I already have experience building models, so I can point out what is right, what is wrong. So you can build this model, and I know it's faulty because most of, okay, let me not get there. Let me not get there. Uh, that is something I've been doing over time, so I can easily know if it's correct or not. Okay. Then people who have experience in that industry can also know. So is not every model that I understand. You need to understand the business for you to understand the model. Okay. So in this case, movie license will not be part of this. I might need to factor it in somewhere around here. I might factor it in other operating expenses. All right. So, okay. So what could be what? So I might say there is nothing we are spending here. We are not spending anything associated with delivering uh, uh, this service to a customer. So once a customer comes on board, the customer comes on board. So all I need to do is to move this guy here, okay? To move it to say, okay, I want to move this guy here, and okay, let me leave it here and then just pass these guys as, sorry. Okay, yeah. So why I'm doing this is that you might remember anyone and you can figure it in here. So I'm just doing 0 here, 0 here. I'm doing 0 here. So meaning that we are not spending anything there. So I'm going to drag this guy to the end. So I'm going to drag this to the end. So I'm going to be a little bit quick or faster so we can end this section on time. So I'm going to drag this to the end. So once you remember, you can specify it and put the numbers there. So this is not my business, so I'm just making an assumption. Okay, so I'm going to drag this to the end also. All right. So I'm going to drag. So remember why we say 5 naira. 5 naira is because we are doing, we are sending SMS to all the customers. All right, so 5 naira. So 1.5, you remember why we are doing 1.5. So the 1.5 is because of the payment processor. So it could be Flutterwave or any other person. All right, so let's go up and see what we have generated from this. So I'm going to carry this. I'm going to copy this, okay? So I'm going to copy this guy here, as you can see, so that I can use it to replace here because I have changed these guys. So I will use it to replace here. Okay, so you see what I have here. All right, so you see here we have 0, 0 because you know nothing is there. So sorry about that. So like I said, my network is a bit unstable and I might be dropping off at some point, then reconnect. So sorry about that. So let me confirm that my network is much stable now. Okay, so can someone just on the chat confirm that you can hear me? You don't need to speak, you don't need to turn on your mic, just on the chat confirm if you can hear me. Okay. I'm waiting to confirm if someone can hear me. I know my network is a bit unstable. So sorry about that. Like I said, my network is kind of unstable. Okay. But I would like to confirm if someone can still hear me. Just use the chats section to confirm if you can hear me. Okay, so I'm just waiting for someone to confirm on. Okay, all right, thank you so much. You don't need to speak. You don't need to speak, just all right. So can one more person confirm that you can hear me? All right, so I'm going to proceed. Can you confirm that you can see my screen? Can you see my screen? Just like I can see a screen. Okay, I think I can see it myself now. All right, so, all right, thank you so much. So when you look at the cost of goods sold here, like, we don't have anything here, so we don't have anything here. Now let's look at the customer support. At the customer support, we are spending 500 naira here. So why are we spending 500 naira? Is because we have 100 customers. So 5 naira times 100 customers will give you 500 naira. So here we have how many customers here? So you can confirm how many customers we have here from here. So we have 170 customers. So we have 170 customers in month 2. So when you do the 5 naira, it
He's back.
I'm really sorry about the whole internet issues. Like, I never saw it coming. But what I'm going to do is I'm going to quickly round off. I believe we are getting insights around how financial models are being designed. And it's about creativity. It's not just about putting numbers there. You can put numbers there. Just like I said, while designing your business model, you can put any number there. Okay. So I'm going to go back and pray that this network will just be stable. Okay, so this happens to be cost of goods sold. Like we said, nothing is here. And customer support, we have 500. And I explained that we have 500 because we have 100 customers in month one. Wow, this network should just be still and be calm. All right, so we have 100 customers and spending 5 naira. Remember, we are spending 5 naira based on our assumption, right? Remember, 5 naira. So 5 naira for those 100 customers will give us 500 naira. So payment processors are going to take 1,500. So here, this is what most companies, people like Jumia, can use this financial model to know, okay, this is how much Flutterwave will be charging us. This is how much Stripe will be charging us. So let us now go and build our own. So by the time you see that in 6 months, you are spending over 120 million naira using PayPal, using Paystack. What happens? You can now say, what if we build our own and use it? So it's going to cost us 100 million to build, and for us to maintain it, why don't we do that? Then once we do that, we can use it and then open it up for other people to begin to use. Now, what does it mean? The reason why you made that decision is because you have seen the numbers of what payment processors are charging you, right? So it wouldn't make sense for you to go and say, oh, we want to build our payment processing when you are just making 10 million naira. For you to do that, maintain it, manage it as a product, it's going to cost you millions of naira. So you don't need to do that. But by the time you scale, you can now begin to do that. I hope that makes sense. So I'm just trying to give examples how financial model can help, especially as you continue to grow. Now you might be designing it gradually, but you use it to make important business decisions. So the total cost of goods sold. So what it means is that it costs us 2,000 naira to service a customer at this point. Now, if you look at our gross profit, we have how much here? We have 93,000 naira. So what is this 93,000? It is here, what we have here, the revenue here. Okay, so we just call it net revenue. Okay, so which is still revenue. Okay, so this is still revenue. So the revenue here minus what? Minus your cost of goods. So this will give you your gross profits. Okay, so our gross profit here becomes 93,000 naira. So what it means is that your margin is 98%. See, if you have a business that is doing 98% margin, that means you are like it's an interesting business, right? Meaning, so if someone asks you what's your margin, you say 98%, right? So the person already knows that you're not spending a lot. So this is how you can begin to think as a business person, as an investor, and all that, right? So that's why they ask you, what is your margin? Right? You say 98%, you say, wow, interesting. So if your margin is 98%, means that your cost of producing that stuff is just 2%, meaning that it's an interesting business, right? So now let's not get back to the next assumption. I hope we understand this aspect. Okay, so if you introduce another cost here, it could increase. Now let's look at another segment of the assumptions, which is operating expenses. So here we are not looking at headcount, which is your salary, your team, and all that. So here, this is where we are going to now begin to say, okay, we have our software developers. So we can call them software developers, or we can call them, depending on what we have, we can call them front-end developers. So you know what you have, okay? So your own might be different people, your own might be sales people, your own might be HR people and all that. So software developers. So here we can now say, okay, sorry, here is front end. So we can say back end developers. So here we can say designers, okay? So here we can say designers. So here might be designers, maybe prototype people, designers. Okay, so here might be, maybe you have so here let's call it UI UX design. So in case you don't understand UI UX, so this is just a career path for people who might be building this product. So your own might be hair makers, your own might be receptionists, your own might be anything. Okay, so this, we can call this projects, can call it project manager, then we can call here executives. So executive might be CEO, CFO, or the CCCC level executives. So executives, so we can call here executives. Now, front-end developers, we can assume that we have only one front-end developer. So here is where we are factoring in how much we are paying. Okay, so we can say, okay, because we don't have money, and if you raise money, you can pay them 200,000, 400,000, 300,000, you factor it in here. But let's say you have not raised money and you are looking for a way to, so you can say, okay, we are going to be paying them 100,000 every month, right? So we are paying them 100,000 every month. Okay, so what did I say? Sorry, I did 10,000. So we're paying them 100,000 every month. So our back-end developers, we are paying them 150,000 every month. So they are more, let's assume that they take more, 150,000. Our US UI, so let's assume we pay them 80,000. Okay. So our project manager, so the person who manages the whole project. So let's assume we pay them 150,000 too. So you see, I'm making the assumption. So here you might need to go to the formula here to change the price. So executives, maybe all the CC people, CEO, CFO, CMO, 1, 2, 3. So let's assume we are paying them 200,000. Okay. So these are the assumptions. We have made the assumptions of what we are paying. So this is now where we now need to calculate how many front-end developers we have, how many receptionists we have, how many salespeople do we have. So here we might not need a project manager. All we might need here is might be product marketer or growth manager. Okay, growth manager or sales and marketing. Growth, let's call it sales and growth managers or experts. Let's call them experts. Anything you want to call it. So let's say for the initial time we are building our product, we don't need any sales and marketing person. So we can keep it 0, 0, 0. Executive, let's say we only have one CEO. Okay, so we can factor the CEO here. And maybe in our first month, we only have one executive. Then so here. So from here, we have 2 executives. Maybe we now have a CFO that is coming on board. So we can have this till maybe at any point. Remember assumptions, all of these are assumptions. So we can get this till month 24. So we can get this till month 24, and then we increase it to 3. Okay. So maybe we now have 3 executives till the end. So that could be what we have. Okay, so I just need to be a little bit faster so it wouldn't be boring. I know we are talking about numbers. Okay, so sales and marketing people, remember we said they can be 0 at this point. Maybe after 6 months, we now bring in sales and marketing, one sales and marketing or product marketer. Okay, so product marketing team. So we can bring one person, and the person will keep doing for the next 2 years, 1 year, 6 months. Then we now introduce 2 persons. So you see what I'm doing. All these are assumptions you are making. When it can change during the course of the business. It can change, but this will just give you an assumption of, okay, when you are now saying we need $5 million, $1 million will go for marketing. Your financials is what is explaining it. Also, it's also an accountability stock for you. An investor will now say, oh, you said you are spending 1 million on marketing, so why are you not spending it anymore, right? From your forecast, so you can also explain, okay, this is why we are not doing that. So that's by the way. Now, UI UX people, you need one UI UX person from beginning, you need one back end, you need one front end based on, so here, benefits. So if you're giving out benefits, you can factor in benefit. Okay, we give benefit, 10% benefit every month. So if we pay you 100 naira, we give you 10% benefit, which is 10 naira. That means you're going to be earning 110 naira. Okay, so for every money you earn 10%. So if you're not giving any benefit, you can just do 0%. Okay, so most salaries come with benefits. Okay, so if there is no benefit, just do 0 naira. So as a startup, you might not have benefit, you just run through 0 naira. So let's just add 10%. Okay, just for assumption's sake. So here we have the front end people. So as you can see from year 2, we have 2 front end guys. From month 3, okay, we still have 2 till the end of the, so back end. So we have back end, so 1 back end person. So in month 6, we might need to have 2 back end people or 2 front end persons, depending on how you are designing, okay, or what you are looking at, the nature of your business. You already know that one, you might do this and say you are doing one back end person. An investor will tell you, I'm not interested, I'm not investing, because you don't know what you're doing. There's no way you are building a movie streaming platform and you have one back end person. That it is not possible. You cannot compete with people who have 1 million 100,000 engineers building. So how will the person manage cloud? Who is managing cloud? Who is managing? So one person can do all that, but will it be scalable and all that? So that's why you need to make sure you have the right set of team and all that. But everything is all left for you. So month 2 here, you can now begin to say, okay, we have 2 software engineers who are coming on board. So UI US remains 1 person, as the case may be. Okay, so let's say we are done with this. Okay, let's say we are done with the salary headcount assumption. So let's go and look at what we have generated. Okay, so when you go up here, so what I'm going to do is I'm going to come back to this assumption and copy these guys. Remember, we changed it. So I'm going to go back here and then look at here. Okay, so you see we have marketers, accountant, and all that. So we can change it to this. All right, so look at this. We are paying 100,000 month 1 to front end developer. We are paying 150,000. We are paying 80,000 here. We don't have any salesperson at this month. Can you see it? So we paid it. So if you check here in month 6, we now have somebody. Have you seen? That's why we hired somebody from month 6 sales and growth team. So that's why we now have 150,000 here based on those assumptions we made. Okay, so what it means is that in our first month, we are going to be spending 580,000 naira, 583,000 naira. So this is what we are spending. So at this month, you see it increases. So also when you go to some months, we are paying 1.243 million because of the number of people has increased and all that. So look at the benefits here. So the benefit is 53,000. So what it means here is that we are paying this person 10% of this is how much? 10% of this is 10,000. 10% of this is 15,000, making it how much? Making it 10, 15, making it 25. 10% of this is 8,000. 25 plus 8 should give us about 33. So 10% of 200,000 is what? 20. So 33 plus 20, making it 53. So are you seeing why you have 53,000 as benefits? So it tells you that you're going to be spending 53,000 naira as benefits. So when you sum everything, it gives you this. So you don't need to, all of these things are already done for you. Just pass numbers. You know what you have there. All right, so that's for this. So we are rounding up as quick as possible. The last thing we have here happens to be other operating expenses. So there might be operating expenses that you run, maybe your rent, if you do rent and all that. So this is where you can factor it in. Okay, so if your server costs, this is where you can factor it in. So here we can now say server costs, for example. So we can call it so let's say we are using Amazon, so we can call it AWS. AWS, Amazon calls it AWS, so we can call it cloud / server costs. Okay, so if we're using this, so what does it cost us to use every month? So there are other services you might be using. You might be using things like what we call Cloudinary. You might be using other technology fees, other technology services and all that. So this might be where we can put it in, maybe technology costs. So if there are technology costs that we are using, this is where, let's say you're using some CRM tools and you are technology costs. So I can factor it in here. So I might be, we might be using some CRM, we might be paying premium Zoom account, maybe. So all of those technology costs, we can factor it in here. So remember, your own business might be different. You might be paying rent. The person who is running this, they might be working at home. Do you understand? They might be working at home, so they are not paying any rent and all that. So if you're paying rent, if you have an office space, you can put it there. So if you have operating maintenance costs, because if you have an office, you might be maintaining it over time. So you might be factoring all those things in and all that. Okay. So this is where you can factor all of those things in here. So here we can just say, okay, ladies and gentlemen, at this time, I believe you can permit me to move to if you can move to the last tab. I believe it's been clear so far and you can play around it once you have your own model. So I'm going to probably, because of these network issues, might have to kind of move to the last tab, which is this because of time. Okay, so I'm just going to assume that we spend 50,000 every month here. That's my assumption. So every month we spend cloud costs of 50,000. Then we are paying some premium technology fees. So I'm going to make an assumption that what we pay there will be some technology fees, CRM and all that. So let me assume also we are spending 50,000 to do that. So remember, it could be some people who might be spending $5,000, $10,000, $50,000, as the case may be. So if you're using dollars, you will need to change the Naira sign to dollars, okay? And then pass your dollar equivalent if you are designing it in dollars, okay? So maintenance, operating expenses. So I'm just assuming that every month, so you could be doing, let's say you buy fuel, you buy diesel, so all of those things will factor, you might just factor them in maintenance and operating costs. So every month you spend 100,000 in maybe operating costs and all that. So every month this is what you spend. So you can just drag it to the end. Okay, so other miscellaneous, the next thing there happens to be, which is this guy, other miscellaneous OPEX, percentage of revenue. So this means, right, what this means is that you can keep it at zero, okay? So you can keep it at zero. What this simply means is that you want to factor miscellaneous and you are taking 5% of every revenue as miscellaneous. That's what this means. Okay, so percentage of revenue. So if you say 5 here, what it means is that you are going to be spending 5% of anything you generate as revenue. So if your revenue is 100,000 for that month, what it means is that you are going to be taking 5%, which is 5,000 naira, is going to move into miscellaneous, right? So that's just what. So if you are not, you just leave it at 0. So the last thing here happens to be tax. So Nigeria by law takes 7.5% of your tax. So remember also where your tax comes to play, right? So if you check what we talked about here, so your tax comes to play when you talk about your net income. Your net income. So your operating income has to do removing your revenue, right? Minus your expenses, your revenue minus your expenses. But when you now remove your operating income, right, by removing the tax from your operating income, that's when you have your net income. So that's why we have to factor this guy in here. Okay, so and according to the law, remember, pay attention, remember that the startup lawyer, the legal person, Mr. Ngu, mentioned that you are not going to pay for tax if you don't make profit. So that is also how this is designed. You are not going to pay for tax if you don't make profit. So this also helps you to see, for example, you are not paying any tax here because you are not making profit. Look at your operating margin, right? Here you can see minus here. So you're making a minus. So you're not going to pay anything. So from your financial model, you are going to start paying when you are making money. So like this, from this model we have designed, in the next 4 years, you are still not making any profit, right? So that's why you are still not going to pay any tax. So even if you keep running without revenue, you keep without profit, you are not going to pay any tax until you have revenue, then you can pay tax. So let's assume that we are spending, I'm making an assumption so that we can have plenty money here, okay? So let's assume we have plenty users here, 100,000. Let's see if we are going to pay tax here. So look at it here. So are you seeing that tax has come here because you're making profit? Are you seeing it here? So you're making profit, so tax has come. You need to pay tax because there is no profit here. But you know this is not realistic. We are not getting this for 100,000 people and all that. So once this drops, okay, to 100 people, so automatically you are not making any profit and you are not to pay any tax. All right, so that's for this. So when you go back to operating expenses, so all I need to do will also need to be to carry these guys here. So which is these three here, and move them up, which is where I have 1, 2, 3. Okay, so I'm changing these three, which is this guy. So advertising spending here, you are seeing here, happens to be this one we have here. So it just changed to this guy. Okay, so that's why you see 50, 50, 50. So that is what you are spending. So remember in your month 6, you now start spending 8. Uh, 6 months later, you start spending 80,000. So we just captured it here so that you can see the summation of all your expenses here. So your advertising spending is this. Your cloud, you are spending 50,000 this month. Your technology, you're spending 50,000. Your maintenance, you're spending 100,000. Miscellaneous, like I said, you're spending 4,750, which should be 5% of your revenue. So what's your revenue? Your revenue is kind of 95,000 here, right? So you are taking 5% of this will give you about 4,000 something. Remember that 5% of 100,000 is about how much? About 5,000 naira. So 95,000 naira, that's why you have an average of 4,750, right? So this 5%, remember we said that miscellaneous should be 5% of that. So if we go back to our assumption and say we don't need this guy here, we don't need this guy, we don't want this percentage stuff here. So what does it mean? When we go up to this place, it shouldn't show again. So it should be 0 here. So you see what we have here, right? So here it still has it. So guys, thank you for staying and all these network issues. So the last thing we have here will be this summary. So this guy here is just a summary of everything you have done. Just a summary of everything you have done. Okay, so that's what this tab is. So it's broken down into quarterly, quarter 1, quarter 2, quarter 3. So this is the full year. You have this. So you also have the next year, which is Q1, Q2, Q3, Q4. So you also have the total. So that's what this tab is all about, which is your income quarterly roll-up. So here you can easily look at this and know that your total revenue for the year is 3.6 million naira. Okay, so here you can also see what is how much are you spending on personnel. So you are spending 1.7 for the first quarter, 1.9 this, so a total of 8. So this is how much you're spending here. Okay, so other OPEX, meaning all of other expenses, all those other expenses, this is what you're spending. So if you look at this is your total OPEX. Your total OPEX for the first year is going to be a total of 11.3 million. Now, and what are you generating? You are generating a revenue of about 3.6 million. So removing your cost of goods, which is servicing each customer, it gives you 3.5. So that is why you are losing money here, which is minus. You can see a small minus here, right? So the small minus here shows you that you are losing money. Okay, so that is why here you are going to lose 7.7, which is okay if you can begin to scale and then begin to reduce the cost. So as you can see, you are not paying any stuff here as tax because you're not making any profit. Like as you can see, this is minus, so you can't pay any tax here. Okay, then your net income is now this minus your tax, so it will still remain the same. As you can see, this and this will be the same thing because you don't have any taxes, so it will drop to the same. Likewise here, and here will be the same because there is no tax. So if there is any tax, it will subtract and then give you here. Then the last thing I'm going to quickly explain will be where you have cash investment. So here, as you can see, you have minus here. So this cash investment is your assumed investment that you raise. So this is the assumed amount of money you are going to raise. So okay, so I'm done. The last thing I wanted to explain is a cash investment. So this is the amount of money you are raising for this. So if you raise 1 million naira here, as you can see, what happens here is that this is minus, meaning you have run out of cash. This is your cash balance, right? So let's assume you raise 10 million naira. So you raise 10 million naira. So if you raise 10 million naira, this money in the month one is going to remain 7 point something million. In month two, it's going to remain this. In month four, so by this time, it's now remaining this, and now it has turned to minus, meaning that you can't continue running. So if you raise 10 million naira, it tells you that in your first year, you can use, sorry, this is Q1, Q2, Q3, Q4, meaning in your first year, the money will remain this. So in your third year, you can no longer operate. As you can see, it's now minus. So at this point, you might need to raise another money, for example. So you might need to raise another 10 million naira. Okay. So you might need to raise another 10 million naira. So this not 10 million. So you might need to raise another 10 million naira here. Okay, so if you raise another 10 million, okay, this is 1 million, not 10 million. So if you raise another 10 million naira, so you see your capital will still keep moving. So this tells you when to raise capital, when you're going to run out of cash, and when you need to raise money. So we have raised another money here. So we keep running. As we keep running, you see at some point this money finishes because you need to raise money because of you don't have enough money coming in, right? So we raise another money here. So let's assume we raise another 10 million here. Okay. We raise another 10 million here. So this should be 10 million, not 100,000. Okay. So we raise another 10 million. So we keep moving. Have you seen this is no longer minus? So we keep moving, and at some point the money will still run out again, right? So we raise another money. So you need to know when to raise money and all that. Okay. So at some point you might not begin to scale and all that. So you just have to be realistic about your model and all that. So thank you for listening, and I hope this is one of the most interesting sections that you have participated, and sorry for the network issues. And so I would want to take questions if need be. Yeah, thank you.